This is how things blow up when you get into an inflationary cycle, because yes, the logical conclusion to in a depreciating currency is to spend it as soon as possible. What that does is push prices up even further, which spooks even more people into panic buying and so on until the thing spins out of control. With inflation being what it is and going where it's going, forms of money that hold their value are going to become more and more in demand going forward. So, one of the questions with, for instance, silver coins is, well, how am I going to spend that, when the time comes? And the answer is, it's going to be really easy because everybody's going to want them. So you're going to be able to trade them for real stuff on extremely favorable terms, because the people who have those digital dollars and that dollar cash, which is rapidly losing its value, are going to want gold and silver big time when the time comes, and there's not going to be any around.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We're always glad to have this returning guest. John Rubino is the founder of dollarcollapse.com. He joins us this Friday, April 8th, 2022. John, thanks for coming back on.
Hi, Dunnigan. Good to be back on.
We wanted to talk with you about several viewers' questions, actually a whole boatload of them that have been submitted ahead of your arrival. But first of all, if you could talk to us about something that should be of significant concern to many people, and that's the Fed really changing their rhetoric to being serious about significantly increasing interest rates in the near term and tightening, because that could affect so many different aspects of people's financial lives. Can you give us your views on that right now before we get to viewers' questions?
Yeah, tightening monetary policy, in a world of very big stories, that might be the biggest story, because the Fed is spooked by the inflation that we've seen and that we're all very painfully aware of right now. And they're making noises like they're going to tighten aggressively, which is very unusual because they've learned the lesson. We've had kind of an operant conditioning program going on for a long time, where the Fed tries to raise interest rates just a little bit and the financial markets collapse and the Fed takes it all back and goes back to easing. And they're behaving like they're not going to play that game anymore, and that they're really, really going to tighten, and it's going to be several hundred basis points and trillions of dollars taken out of the Fed's balance sheet. These are the things they're saying. And interest rates are going up accordingly. The 10-year Treasury now is at like 10.6% yield versus below 1% in the very recent past. Meanwhile, mortgages, they were 2.5% for a 30-year mortgage pretty recently, and now they're above 5%. So interest rates are going up, which runs the risk of choking off the whole leverage speculating community, which is basically the whole world right now. In other words, anybody who's long tech stocks, anybody who's thinking about buying a house, people like that are going to be affected dramatically by rising interest rates. So we could easily have a stock market crash that flows from rates going up a little bit more from here. It won't take much to spook the stock market. And the question then becomes, will the Fed put up with that? And they're acting like, they're going to let stocks tank in order to rein in inflation. And if so, that's a situation that we have not seen since 2008, 2009. The whole decade plus that we've lived through since then has been easy money. And if we're going to see suddenly tight money, stocks in particular, priced for perfection, are not going to behave well.
Well, my wife and I are particularly sensitive to this because we're looking for a home right now. And so we've been watching with some anxiety the interest rates creeping up. And but that affects not only buyers, but sellers, because the prices that are being supported in this market for sellers are also buoyed, as the stock prices are, on the back of that low interest rate environment. Is that not the case?
Yeah. And, one of the things we've seen in this housing market for the past few years is really low inventory. Nobody really wanted to sell for some reason, which is a surprise demographically, because usually, when a generation retires, they sell their big houses and move into smaller houses. But boomers haven't been doing that. But just lately, you're seeing an explosion of supply. All of a sudden, people are thinking, oh man, this might be my last chance to get that amazingly high price for this house. So let's put it on the market. And the way that normally works is that pushes prices down because you get too many people trying to sell. All of a sudden, it's it's a buyer's market. So you and your wife might want to wait for a while and then start putting in some lowball bids to see if you can catch somebody who's really panicking, which is, in this housing market, that sounds pretty strange. That hasn't happened for such a long time. But we haven't had tight money for such a long time.
Well, that's the other thing you mentioned in passing was the 2008 similarity, because you can't help but remember that in 2008 we had the whole real estate market cave in, and a lot of people found themselves upside down or underwater. People who were leveraged in that regards, holders of multiple Verbo or that kind of properties were hurting. Can you talk to us about that overall overhang in the real estate market before we move on?
Yeah, well, this has been just lately a real estate bubble, not as extreme as the one in 2006, 2007, but there's been a lot of bubble-like behavior with, for instance, bidding wars, with people paying way over the asking price for houses. In the auto market, the MSRP, and in the home market, the asking price have switched from being the point at which you negotiate down to the point at which you negotiate up. In other words, you see the asking price, and then you wonder what kind of a premium you have to pay over the asking price to get that house, which means a lot of people have overpaid for houses lately. That's the kind of thing that, first of all, impoverishes the people that overpay for the houses, and then it spooks a lot of them too, and leads them to behave in ways, peak bubble bursting behaviors where they try to get out for any price and find that they can't do it. We could see the housing bubble burst pretty soon, with all that implies for the overall economy. Housing is a huge part of the economy. And when it's going up, it's a huge growth driver because, to build a house, you've got to hire a lot of people and you've got to buy a lot of raw materials. And then to furnish that house, you've got to buy a lot of furniture, and it just goes on and on, stimulating the economy. When housing turns down, that process shifts into reverse. So that could be one thing that we see with tighter money is, bursting of the housing bubble, falling home prices, lots of people defaulting on their mortgages, that kind of thing. In other words, basically what we saw in 2008, 2009, maybe not as extreme, but still pretty extreme if you're paying attention to it.
Other implications of a rising interest rate environment, you mentioned equity markets, stock markets can get spooked, and there can be a cascade effect there because there's, can you talk to us about the leverage effect that's been, margin effects, et cetera, working on the upside, and how that cuts both ways when it turns the corner and starts going to the downside?
Yeah, well, there's a huge amount of leverage in the stock market. And one aspect of that is margin debt, where people borrow against their existing stocks to buy more stocks. And that's great when stocks are going up. You turbocharge your returns, but as soon as they start going down, it turbocharges your losses. And then you get things called margin calls, where the broker comes to you and says, you have to sell your stocks or put in more cash, or we will sell your stocks for you in order to maintain the balance between your equity position and the debt you've taken on. And that can kind of cause a cascade in stock prices where brokers are selling people out of their accounts, which pushes down prices, which pushes more people underwater, which forces the brokers to sell more, and it goes on and on while stocks just collapse. And we've seen kind of sort of things like that when the Fed in the past tried to tighten. There's a thing called taper tantrum, where the Fed tries to taper its monetary ease. Stock markets tank, they throw a tantrum, and then the Fed panics and backs off. And a good example of that is December of 2018, when stocks had been just rocking and the Fed decided to raise interest rates just a couple of times, very minor tightening. And in December of that year, stocks just went straight down. And that was a very minor tightening, and stocks were not nearly as overvalued then as they are now. So we could see a much more exaggerated version of that very easily if interest rates keep going up. And The question is, what's the interest rate that does this? Will it be 2.75 yield on the 10-year, or does it have to go to 3.5? We don't know. We won't know that until after the fact. But that number is out there. The number that breaks the financial markets is a real thing, and it's out there somewhere, and we're heading towards it. So the question is, when did we get there?
The other thing that I haven't heard us talking about just now in the context of an interest rate rising environment is the very significant impacts of that on servicing the national debt and, frankly, any other jurisdictions, municipalities, everybody who's got debt. Can you talk to us about that for a moment? What's the real impact to the U.S. as a nation or other large debtors in a rising interest rate environment?
Well, yeah, most of the governments of the world have borrowed huge amounts of money, frequently kind of short term, 1 year, 3 years, 5 years, that they have to roll over. But rates are so low, or have been so low at that end of the spectrum, that they've, it's been basically free money for them. In a lot of cases, to the extent that they, a lot of governments have been borrowing at negative rates, for instance, which means, get this, the more they borrow, the lower their interest cost and the lower their deficit, because they're actually being paid to borrow money. Now, that's all switching, where these formerly negative rate bonds go positive. And the governments of the world have to roll that debt over at higher and higher interest rates, which means their interest costs are going to explode if this continues, which means their deficits are going to explode. At the same time that maybe the global economy is going to start slowing down, which would explode deficits in any event. So you're going to see some really horrendous numbers come out of a lot of the world's governments because of rising interest costs and rising expenses otherwise with a slowing economy. And that's just going to make things worse. If you didn't really trust sovereign debt before, you will absolutely not trust it going forward when you see the numbers that come out of a lot of these governments. And, it's possible that we start talking about national bankruptcy in some cases. But before that happens, remember, all these governments have unlimited printing presses. So what they will do is they'll just print the currency. If they're, the Bank of Japan or the European Central Bank, they'll just print as much new currency as it takes to cover their exploding expenses. But that will have the effect of pushing down the value of their currency. So you trade a debt crisis for a currency crisis out there somewhere. And that's a very real thing too. And that can happen easily if rates keep going up. So, we've got multiple crises that flow from tightening monetary policy, and one feeds into the other. So you run the real risk of kind of a death cycle where one thing goes wrong, that makes the other thing even worse, which then goes wrong in a big way, which makes the first thing get even, and this continues with no real end in sight. So that could be the kind of world that we're entering into in the next couple of years if central banks continue to try to tighten. But on the other hand, if they give up and stop tightening and go back to ease, then inflation will take off from here, and from a really high price like that, from 7 or 8% official inflation and let's say 12% real inflation. If we were to go back to easing, that would risk even higher rates of inflation, which would destabilize the financial market. So we're kind of in a box where there's no easy solution. And everything we do runs these gigantic, horrendous risks, but we have no choice but to choose. Not choosing is still a choice. So if we keep things exactly the same, or we tighten or we loosen, all of those things are choices. All of those things potentially lead to some kind of gigantic crisis. So the powers that be have, they've built this house. They've made their bed. They have to live in it. But they are in it now, and they really don't have any good choices. But they do have to make some kind of a choice. So fascinating time for, an economics nerd from a theoretical standpoint. But, if you're a regular person trying to build a nest egg or a retiree trying to live off of your savings, this has got to be one of the most terrifying periods in human history.
You mentioned quite a bit of the global aspects of sovereign debt impact from increasing interest rates. What about domestically here in the U.S.? How is this going to impact our ability to service our own national debt, or will the debt just run away? Because when we talk about inflation running away, there's this hockey stick from either overprinting of currency and then devaluation and that sort of thing. But this seems analogous in the sense that if you already have this much larger national debt than we've ever had before, and then you suddenly have to pay a much higher interest rate on it, is that going to cause a runaway of the national debt, even acceleration beyond what it's been doing recently?
Yeah, I mean, it's already soaring. The national debt is at a point where, it wouldn't take a very big increase in the interest rates that we have to pay on that debt to throw the federal budget into chaos. And we're pretty much there. But, as I said, the way that the U.S. will respond is the way most other countries will respond. And that will be to create as much new currency as it takes to cover these new costs, which means the national debt, the amount of money that the government owes, will go up even more dramatically once that process really gets going. So there doesn't seem to be any end to it because, we're not going to default on our debt because we have a printing press. We can create enough new currency to cover our interest costs, whatever our interest costs are, but at the cost of rising debt at an accelerating rate. So you reach a point where there's no way out, and you could argue that we're there now, but if we're not there now, we will be there soon. We're heading in that direction and there's no way to stop it.
Yeah, another way of phrasing it in my mind, what you just said is, you don't have to default. You can just keep stealing money from everybody's checking, savings, earnings, and retirement covertly by destroying the purchasing power of the currency. People wonder how they protect themselves from that sort of thing. One question, Debbie Nugent says, how much cash should one hold? I know this is a question of debt and so on. Should you be spending your money before the next increase of debt, impacts the currency even further? So that's a very perceptive question. Should you be spending, in other words, getting rid of your cash before they destroy it further?
Yeah, see, this is how things blow up when you get into an inflationary cycle. Because yes, the logical conclusion to in a depreciating currency is to spend it as soon as possible to buy all the stuff you're going to need in the next couple of years right now, instead of waiting and going to Costco the day you need it. What that does is push prices up even further, which spooks even more people into panic buying and so on until the thing spins out of control. So yeah, that's. Prepping is one logical way to deal with inflation. And that's why once the inflation genie is out of the bottle, it's very hard to put it back in because you get people acting in ways that accelerate inflation instead of slow it down. How you should prepare for it, other than buying the stuff you're going to need a year in advance, would be to, yes, hold a lot of cash, but not currency cash. Dollar cash is going to be depreciated dramatically by government policy going forward. So you want to look at older kinds of cash like gold and silver, where the supply is limited, governments can't make more of it. Therefore, its scarcity tends to cause it to hold its value going forward, no matter what's happening in the world. So with gold and silver, you'll probably see their prices go up enough to offset the inflation that we're seeing in the currency, and that protects you. That protects the part of your finances that would normally be in cash. And then beyond that, there's an investment thesis that flows from this, which is to get into real things. The same characteristics that make gold and silver valuable, scarcity, a slow increase in supply that governments can't affect. That applies to lots of other things like oil wells and farmland and rental houses. So if you shift your finances in that direction so that you own gold mining stocks to the extent that you own stocks and you own some real estate, very well chosen, very carefully chosen real estate in a place that isn't super cyclical and that has a function, not just, a condo in Miami that only has value if some Brazilian wants to buy it as a place to stash his cash, but a piece of farmland that produces food, which we're always going to need, has an intrinsic value that will not change during an inflationary period. So, you start directing your finances in that direction, and to the extent that you do it, you become more and more protected from what's coming. What you don't want to do have a big exposure to things that governments can create in infinite quantities. So you don't want to own a lot of bonds that just pay you in dollars at a time when dollars are depreciating. You don't want to own a lot of bank stocks because banks basically just depend on paper currencies for their value. There are lots of other things like that. The home builders, they depend on an ever increasing supply of ready cash for home buyers. You take that away, and their value drops dramatically. So you could, if you're aggressive, you could do a long short strategy that would be potentially brilliant. Going back to 2006, 2007, if you went short the home buyers, short the banks, long precious metals over the next decade, you made a lot of money. And it's in some ways similar, but much more extreme today. So it's completely possible that there's another big short scenario out there where you can bet against things and they'll go down and you'll make money. And that there are a lot of things that will go up in the coming environment. So you go long them and you make a lot of money. So this can be done. You can definitely invest for the coming crisis and do really well. It's just that you have to unlearn a lot of things. The conventional wisdom of financial planners of the last 70 years, which has worked brilliantly, is no longer going to work in this environment. So you have to do things that the experts would tell you are not wise. And you just have to be brave enough to ignore them and listen to people like you, Dunnigan, instead of, their stockbroker or financial planner.
The other thing that we haven't touched on related to the dollar is how different global currencies are or are not being backed. Until recently, we've talked about all currencies across the globe being fiat. Now, for the first time in history, nobody's backed their currency with precious metals or anything else tangible. But just in the past couple of weeks, we've had Russia come out and, at least for a certain period of time, for certain purposes, back the ruble with gold and also require payment from Western European countries buying energy, such as natural gas, etc., to be paid in rubles. Can you talk to us about how you see the balance of power shifting affecting the global reserve currency or alternative methods outside of the U.S. dollar?
Yeah. First, let's take a couple steps back and look at the cause of what's happening in the monetary arena. The U.S. has been abusing the privilege of a reserve currency for the past couple of decades by punishing anybody who steps out of line with the threat of, basically being kicked out of the global financial system. And they're doing that now with Russia in a big way over Ukraine. And that's leading Russia to take affirmative steps instead of just waiting to be punished. It's basically extracting itself from the global financial system. And China, Russia, and India have been kind of preparing for this day for a long time by accumulating lots of gold and silver, because they assumed the time would come when when they butt heads with the U.S. tries to kick them off the SWIFT system, for instance, of bank settlement and try to impose sanctions that keep them from being able to sell the things they produce on global markets, and that they would have to kind of get by on their own. So Russia is in that place now, and what it's doing is saying, okay, instead of requiring dollars for our oil or our natural gas or our gold or our wheat or whatever else, our fertilizer, all the things that we sell on the global market, we now want rubles. So you have to go out and buy our currency and then give it back to us in return for our stuff. It's also talking about buying gold and paying for it in rubles, which kind of, not quite, but kind of sort of puts the ruble on a gold standard. This is a huge deal because, if it's just one country that does it, it won't affect the world. But since everybody else is watching this and they all have the same problem with the U.S., if other countries start doing that, where they cut bilateral trade deals, where they buy and sell things in their own currencies, or they start demanding payment from the world for the stuff that they're selling in their own currencies, then that becomes kind of a runaway train that the U.S. might not be able to stop. And it will be our own fault. I mean, we screwed this up and we are reaping what we've sowed. But it would be a huge deal for the value of the dollar, because right now, there are $100 bills all over the place out there in the world, and treasury bonds all over the place. And if all of a sudden those currencies and other financial instruments aren't needed to the extent that they are now, then what most people will do is they'll sell them, or they'll just send them back here and buy U.S. assets with their dollars or whatever, and that's going to lower the demand for dollars and push up the yield on U.S. bonds and lower the value of the dollar in foreign exchange markets. So it would be a big crisis for us if all of a sudden $10 trillion tried to get back here from the rest of the world, and the dollar crashed and prices spiked, and so we would have this massive inflationary situation that there's nothing we could do about it, because we created those dollars. They're out there. We're required to accept them in payment. And there's too many of them, so the value has to fall. So this is a very big, very dangerous thing for the U.S. And I can't stress that it's our fault. We brought this on ourselves. And if there is a currency crisis that centers on the dollar, it'll be because of our own mismanagement.
So what you've just described, I think, hits the nail on the head for this one from I'm Joking, who says, how fast would the collapse of the dollar as the world reserve currency impact hyperinflation within the United States? Sounds like it could be, as fast as those dollars coming home.
Well, let's say Russia gets by doing what it's doing. And right now, the ruble is stronger than it was before the Ukraine invasion, which means, in terms of currency, foreign exchange rate, Russia hasn't suffered at all. And so let's say China sees that and decides that maybe they want to try it too, and then maybe India. That would cause a very quick change in the calculus for a lot of other countries about how many dollars they need to hold. So, it might be this gradual thing that takes place over a decade or two, or it might be the kind of thing that happens in just a year or two. Sometimes things happen very quickly anymore. And it's completely possible that there could be a changing of the guard in the global monetary system more quickly than seems reasonable right now. And it could be that it's that it comes from the top down instead of from the markets up, where the powers that be just decide that we're going to call a new Bretton Woods meeting and we're going to revamp the monetary system, and the dollar is no longer going to be the world's reserve currency. We'll have something else as the world's reserve currency. So the dollar is just one of several or many important currencies out there. And the day that agreement is signed, everything changes for the dollar, because all of a sudden the world just doesn't need that many of them.
Back on the ruble and gold, there's a question of how that might impact the gold markets. Bruce Barr asks, since Russia pegged the ruble to gold, as demand for the ruble increases, the ruble will rise, and so should the price of gold. How will this affect the price of gold as stated on the COMEX and the London exchanges? How soon before China, India, Turkey, Brazil, and all export their goods pegged to gold?
There's no way to know that, but it's possible that it becomes a trend. And if it does, that's great for gold, obviously. And it's bad for the dollar, which gold will be replacing in global trade. The other thing, as regards the COMEX, we saw the London Metals Exchange just melt down not too long ago with nickel, where the price of it went up. There were a lot of shorts that were going to blow up if they had to make good on their short contracts, and the LME just canceled all those trades. So now all of a sudden people don't trust the metal exchanges of the world the way they maybe once did, and so it's completely possible that we see something like that in other metals or in other commodities. And if it becomes a thing, something that happens fairly frequently, then that means nobody wants to have big exposure on the exchanges anymore, which means they can't play the paper games they've been playing to suppress the price of a lot of commodities out there. And, gold and silver are the main victims of those paper games. So you take away the ability of the world's big banks to short gold and silver at 4:00 in the morning, New York time, and just hammer it down to chase people out of their long positions. If they can't do that anymore, and the physical trading of gold and silver determine the real price, then that would be good for them too. The price would probably have to go up quite a bit in both of those metals to reflect the fact that physical prices are just naturally higher than the paper prices that you see out there.
Yeah, that's what came to mind when you were talking about buyers needing to overbid on real estate if you really want to take physical possession or other things. And I was thinking, just like physical metals. McKelliak asks, do you think the dollar will slowly wither away or suddenly collapse, and why? And in a sudden collapse scenario, what are the final indicators you're looking for just before it goes?
And one really important caveat here, trying to time this kind of thing, if you're trading it, is impossible. Because by the time it becomes obvious that something is happening, it's too late to make a favorable trade. All the stuff you wanted to buy is just priced out of your reach. So you kind of have to prepare ahead by taking positions that may not work out right away so that you're there when they do work out. Now, having said that, there's that old quote from Hemingway about a friend who went bankrupt, and Hemingway asked him how he did it. And he said, well, slowly at first and then all at once. And that's probably the way it'll go in a lot of financial markets now, including the foreign exchange markets, including the dollar, where we are now in the kind of slowly process here, where the dollar is losing value at an accelerating rate, but still not in a disorderly way. But the time might come when, you just wake up one morning and something happened out in the world, and all of a sudden there's this huge discontinuity in the foreign exchange markets, and the dollar has tanked. And you can't know when that's going to be, because it depends to an extent on, geopolitics and decisions that haven't been made yet by important people out there in the world. But it's highly likely that it will happen at some point, just because we're taking on debt at an accelerating rate. We're inflating away our currency at an accelerating rate. Sooner or later, that becomes parabolic, where it just falls off the table. No idea when. Could be next year, could be 10 years from now. But since we're heading that way, that should inform your decision-making with your own finances, because you want to be flowing with the tide of history rather than standing against it. And the tide of history says that the fiat currency experiment has failed, and its failure will be recognized by everyone pretty soon. We don't know when exactly, but that failure and the recognition of it is going to be front page news eventually. So you want to be set up so you benefit from that instead of really suffering from it.
Yeah, two things come to mind on this point. One is that as the founder of our channel, which used to be called Reluctant Preppers, as you know, when you first joined us as a guest, there's that whole principle of I'd rather be 7 years early than 1 day late, because as you mentioned, when most people suddenly wake up and get the idea that you better scramble for this, this, and this. These are the only things that are real, that are left, is these tangibles. Good luck trying to find them, or good luck trying to get them at a reasonable price, or any customer service, any predictability, anything like that. So the time to do it is when it's out of favor, out of the public eye, out of mindset. You've got to be willing to be a contrarian, just like Noah building the ark. You've got to be willing to be the oddball in your family or in your neighborhood or in your circle of friends around the coffee pot at work or whatever. Because if you wait for the group or the crowd to validate your gut feeling about what you ought to be doing, it will be difficult to impossible to do. The other thing, we keep circling back around to this idea of destruction of fiat currencies and the purchasing power, and that certainly is an unfamiliar realization for most people. It shouldn't be, because there's even the saying, the buck ain't worth what it used to be. We all know we used to be able to buy a candy bar as a kid with a dime or a soda pop or whatever. So people know that things have really changed, and that they cannot purchase what they used to with the currency. So that relying on currency as a storage of value is not a winning strategy at all in the environment that we're in. There's a question about how fast that's happening in reality. Trail Cruiser says they're seeing 20 to 50% increases in some or most German retail goods, and they're shocked by that. Is a multi-% hockey stick inflation in our future as well? How long before drastic rises hit North America? Again, what are you seeing in terms of your outlook for inflationary price increases that people can't ignore in the U.S.?
Well, we've been creating crazy amounts of money for the past 30 years, and now it's starting to push prices up in a really noticeable way. But it's not clear that we have continuing inflation at this level in our future, because higher interest rates are anti-inflationary, and slowing economy is not inflationary, and we're liable to see those things in the next year or two. So it's possible that soaring prices will be less of a big deal than plunging prices if interest rates rise to a certain point. But that's just that's a little intermission in the inflationary process, because governments will respond to, say, a slowing economy and a crashing stock market at some point with even more easy money, which will ramp things back up again, only from a higher level. So, we are in an inflationary period, and there are going to be stretches within that period when it goes the other way, when we have a recession or a crash in some big asset class category, and it feels like that could be the story of the next couple of years, just because we're setting the stage for real estate and stocks to go down hard. So inflation might not be this linear thing where, okay, it was 12% this year, it's probably going to be 15% next year. It might be 12% this year, 3% next year, and then 25% 3 years from now. So it's not the kind of thing that you can predict in a year-by-year fashion. It's going to go, is more of a step function. And as we make bigger and bigger mistakes, the results will be bigger and bigger. So, I don't really have a prediction for inflation a year ahead or 2 or 3 or 5 years out. I just think that the general trend is up, in the sense that the general trend in these big fiat currencies is down. We're inflating our currencies away. At some point out there is the crack up boom where everybody figures it out and then prices go straight up. But in the meantime, we probably have this kind of up and down process with a general overall uptrend, but with some downtrends in it.
What I'm hearing from you is that we should expect a lot of volatility in the next several years. It could be dizzying melt ups, and then gut wrenching meltdowns, and it could swing and seesaw back and forth depending on the scrambling actions of the monetary gatekeepers to try to rein in this as the spinning plates start threatening to fall off their pedestals. We could have some wild swings, it sounds like. So buckle up your seatbelts is what I'm hearing.
Yeah, and which is really what we've lived through since the 1990s, where we have a boom, then a bust, then an even bigger boom, then an even bigger bust, and so on. The amplitude of the cycle is getting bigger and bigger. And this is the biggest ever, what we're living through right now. We have never seen a global economy in this kind of a bubble. They call it the everything bubble for a reason. It's not just one sector. It's a whole bunch of different things that can legitimately be called bubbles right now. And when one bursts, it'll probably blow the other ones up too. So yeah, that's what we're looking at. And it makes it very hard to predict. It makes it very hard to trade this kind of a market. But since the general trend is really clear, it also makes it fairly easy to set up a general portfolio that'll benefit from that kind of thing in the long run.
A lot of the assumptions we're making when we talk about setting up any kind of a portfolio or being able to do that is that there's a stable enough environment within which it's clear what's the framework, what are the rules, what are the currency we're dealing with, etc. There's been lots of talk about central bank digital currencies, and people are concerned that will completely be a game over, new game. And any of the old rules you can't count on at that point, any privacy you can't have anymore, etc. Can you talk to us about your view, since you run dollarcollapse.com, of what you think is the next thing we should expect in terms of currency, and how it will affect our ability to transact at all, to invest at all, to have privacy at all, etc.?
Yeah, all the big governments now, because they technically can do it, have decided to set up central bank digital currencies, which is basically Bitcoin run by the Fed. And the idea behind it is simplification and efficiency, at least on the surface. But behind that is a total loss of privacy. Like you said, if you do away with cash, which you have to do with a digital currency system, then everything you do can be tracked. And you have no financial privacy, and you can be controlled, because the governments of the world will be able to, for instance, block your bank account from being used to buy certain things or to make political donations to certain people. We saw that in Canada right now. That's a glimpse of the future. And it can also, your bank account can be used to force you to spend by putting an expiration date on the currency that's in your bank account. If you don't spend it, you lose it. They have that power over you, and they love that idea. But as far as inflation goes, as far as the value of a central bank digital currency goes, no change. I mean, a digital dollar is still the dollar. It still depends on supply and demand. We're still creating way too many of them. So the supply is going to be such that it forces the price down at some point. So that doesn't stop inflation. That doesn't give governments any control over the value of their currency. It just gives them control over the users of their currency. So in that sense, we should not like that trend. That's that's a step in the direction of a global dictatorship, and we should oppose it. And you oppose it by, hoarding cash for now, some cash, and lots of gold and silver to transact in, and getting to know cryptos and seeing if they would work for you as an alternative. Although governments are going to try to put a stop to that pretty soon. So that is a subject for a whole show, the political implications of governments trying to control cryptos. Yeah, they're going to do the digital currency thing. That just makes the case much more strongly for gold and silver, because those are the things you can transact in privacy. And with inflation being what it is and going where it's going, forms of money that hold their value are going to become more and more in demand going forward. So, one of the questions with, for instance, silver coins is, well, how am I going to spend that, when the time comes? And the answer is it's going to be really easy, because everybody's going to want them. So you're going to be able to trade them for real stuff on extremely favorable terms, because the people who have those digital dollars and that dollar cash, which is rapidly losing its value, are going to want gold and silver big time when the time comes, and there's not going to be any around. So if you've got some, by the way, don't advertise that you have a lot, because that makes you a target. But if you have some, if you're at the farmer's market and you pull out a silver eagle or something like that, prepared to be to get all the fruits and vegetables that you're going to need for the next couple of weeks easily from some really grateful farmer. And it's the same thing with gold coins. If you want to buy a used car, if you've got a Krugerrand, you're going to be able to get a used car very easily going forward. So the digital currency thing, it makes the case for gold and silver, and creates a conflict at some point in the future between governments that want to control us and people who don't want to be controlled. But along the way, gold and silver will get a lot more valuable, and these digital currencies will get a lot less valuable. That's pretty much baked in the cake.
We can't help but anticipate that the verbiage that's going to come out of government, the officialdom, and it's going to be just absolutely uniform message on all media channels and all advertising, everything, is that for the good of the stability of the financial future of our country, we need to manage these things better. We're going to do it through this official centralized method. That's number one. So to prevent crisis, and that of course affect national security, because you don't want foreign countries messing with your currency, etc. And this way we're going to be in control of our own currency. Secondly, they're going to say that those who hold tangibles, like you say, and try to transact with them directly, are participating in illegal activity, black markets. This is for crime and terrorism and that sort of thing. So, in the past, it's been very effective to move the groupthink by basically smearing people who are trying to maintain the shreds of their own privacy and freedom by calling them basically enemies of the people, enemies of the state. Because if people were being good and virtual signaling, saying, if you're going to do what's good for your country and do what's good for your community, you'd get on board and get on this nice stable system that we're going to help you manage, rather than do this going rogue and doing the hoarding and that sort of thing. Can you talk to people about how you I guess, brace yourself or fortify yourself or plan on how you're going to get through the psychological, emotional pressure of being told that, you're at best selfish and at worst criminal or terrorist or whatever for just trying to take care of your own family.
Yeah. Well, one of the tricky things about an evil government is that it defines good people as criminals. And so you find yourself on the wrong side of the law, maybe for the first time in your life, when your country goes authoritarian. And that's liable to happen in the financial realm. You know, we saw it in Canada just lately, where the truckers were neo-Nazis and white supremacists, which of course they obviously demonstrably weren't. But probably it's going to be the same thing with gold bugs. You know, if you want to find a gold bug, look for the Nazi flag. Well, we'll see things like that coming out of the government. And so we're going to have to make a decision. Do we want to be criminals as the government defines criminality? In other words, do we want to be part of a black market in our economic life? Or do we want to take the easy way out and do what we're told? And it's a personal decision with a lot of ramifications. And it's a choice we'll have to make at some point if the governments of the world go full authoritarian, which they seem to be doing now. You know, they're putting a lot of the pieces in place for that turnkey totalitarian system that people used to talk about, and it's now becoming a real thing. So yeah, this is we're leaving our kids with kind of another civil war that they're going to have to fight, and it's going to be between the forces of control and the forces of personal freedom. It's going to be ugly, but it's also winnable, because remember, the police force that they will depend on to enforce their rules is going to be made up of mostly regular people who sympathize with the freedom mindset. And it's also going to be people who own guns, so it's potentially very scary and it's potentially something you wouldn't want to have to live through, but it looks like we are going to have to live through it. There's not much choice at this point of some kind of a conflict between the people running the show right now and everybody else. So, yeah, I hate it that we have to talk in these terms and we have to think in these terms, but this is just the world we've inherited. Or in the case of baby boomers, the world we've created. Sorry about that, everybody else. My generation has a lot to answer for it. Yeah.
younger generations, right? So, I guess one last aspect of this. When you talk about black markets naturally springing up throughout human history in response to those authoritarian overreach by government, Bill Wood says last week he saw a selling point in the mainstream media that CBDCs will prevent black markets from popping up. Can you think of any example in which a government intervention has hindered black markets?
No, never. Governments create black markets by defining things as illegal. And, sometimes that's appropriate, but frequently, maybe the majority of the times, it's not. The things that big black markets tend to spring up around are things that people basically want. Consenting adults who should have the right to do whatever that is and own whatever that is. That's where the big black market is. And so you see that in drugs. You see it in guns to an extent. You see it in gambling, prostitution, things that consenting adults do because they would like to do it, and the government has declared them to be illegal for one reason or another. And governments never succeed in controlling those markets just because people are crafty. We will figure out a way to get what we want by bypassing the powers that be. And the only way you can stop that is by basically designating one cop for every person in the world. And that's, the Soviet Union kind of tried that. It turned out to be economically difficult. You got to pay those cops. And mostly they'll become corrupt because the people who are in the black market can pay more than the government can. So the system breaks down. But what you've succeeded in doing is defining a huge part of your population as criminals. We did that with the war on drugs in the US and are finally waking up from that. We'll probably do it with a lot of transaction related stuff. So it won't be the things we're buying as much as the way we're buying them that'll be outlawed. And we'll get around it. The black markets will succeed, but it will be an incredibly messy process, I think, because if the guys in charge now are representative, if the Trudeau in Canada or most of the the military industrial complex / corporate media here in the US, if there are examples of the people that will be in charge 10 years from now, then they won't hesitate to use force to control people who are crossing them. So that's our world. Sorry. On behalf of all boomers, I'm sorry that we did this.
Yeah, it's very grave environment that we like to think that we're going to leave the world a better place for our children and grandchildren. And this is a real reason for concern that, and I don't think that we can claim that the ordinary people have truly opted in on this, but it seems to have been laid out, and we've been shepherded and guided into the roles we're supposed to play in this system that increasingly takes away freedom, power, privacy, control from the family, from the individual, and concentrates it in fewer and fewer hands. Sure, there's an aspect to which we participate in that by taking the lazy way out and saying, yeah, I guess I'll go with the flow. And you're right. At some point, if we continue to comply, continue to go with the flow, you're left with no further freedom at all. That's why our channel is called Liberty and Finance. John, if people want to follow your work, where should they get plugged in?
Well, I founded dollarcollapse.com, and Dunnigan, I just sold that site and will be kind of ambling off into the sunset pretty soon. But the new owners, new managers are very good. I expect the site to be excellent going forward. So, go there and put your email address in the join the email list box, and you'll be able to get what dollarcollapse.com continues to put out there. And it'll cover most of what we talked about today.
And I want to remind all of our viewers that we have almost 60,000 subscribers on YouTube alone. We're also on Brighteon, Rumble, SoundCloud. And yet, signing up for free on libertyandfinance.com to our free newsletter, where you get a link to every single interview, both the audio and the video, only has about 2,500 subscribers. So there's about 55,000 more y'all that need to go to libertyandfinance.com, put in your name, your email address, click submit, and then just confirm when you get the confirming email. And you'll get a free email delivered to your inbox with every single interview we do. You won't miss a single one. And I want to thank you, John Rubino, founder of dollarcollapse.com, for joining us again on Liberty and Finance.
Great. Thanks, Dunnigan.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.